Joining me now is what I like to call one of the soberest minds in the precious metals space, Jeffrey Christian from CPM Group. And Jeffrey Christian, thanks for joining the podcast.
You're welcome. I love working with the Northern Miner.
Oh, great. Yeah, we love working with you too. I've been at the Northern Miner for 7 or 8 years, but I've been following your work for 10 or 11. So it's great to have you on. And we're a week and a day away from the election. And it's really exciting times out there with all the COVID and the stimulus and all these huge debts that are being racked up. So I wanted to interview you and get your take on things. So where do you see the precious metals market, a week before the election, and just here we are in the fall of 2020? Where are we?
Well, we're in a place where, when you say precious metals markets, we have to disaggregate, because gold is one thing, silver is another thing, and platinum and palladium are a third thing. The gold market and the silver market and the world economy and other financial markets collectively are all hostage to the political drama. And the main political drama is the U.S. election, not just for the president, but for the Senate. But there's also Brexit out there. There's the U.S.-China hostilities. There's Russia's hostilities with the world. There's U.S. hostilities with the world. There's a big glob of political problems that the world's confronting. We have the pandemic, and then we have the economic consequences of those two problems, the political and the public health issues. And so the markets are all beholden to that and what's going on. And honestly, I do believe it's too close to tell what will happen both in the senatorial races and the presidential race. It looks right now as if the Democrats could take the Senate and the presidency, but I don't think that that's a foregone conclusion. One of my clients and counterparts gave me a very interesting study about how Republicans tend to lie more about who they're voting for than independents or Democrats, because they're usually embarrassed.
Right.
You saw that in 2016. You saw that in earlier elections too. So I think it's too close to tell. But I think that there'll be some volatility. There has been some volatility leading up to it. I wouldn't be surprised to see a number of black news coming out both against Trump and Biden. Obviously, Trump seems to have a lot more bad things that you could say about him than Biden. I think the worst thing that you can honestly say about Biden is that he's a lifelong Washington politician. And everything else is nonsense. But I think that you could see some issues in the next 8 days, over the next couple months up until December 16th, when the election has to be decided, even if it's by the Supreme Court. I think you could see a lot of uncertainty, and that will coincide with the move toward Brexit. And then even beyond that, you go back to the longer term issues, which are all those political and economic and financial market problems that the world faces that are not being adequately addressed. And it almost doesn't matter who wins in Washington. You're probably not going to see ethical and intelligent resolution to those problems.
Yeah, I think there's probably a lot of people that would agree with you on that point. And so in terms of gold and let's say silver, but maybe primarily gold, are you of the opinion, as kind of a lifelong, you've dedicated your career to the precious metals, do you see, in a sense, a correlation between disaster and bad news and it being good for gold? Because I've been watching that and I don't always see that direct correlation that people tend to want to make. Is that an oversimplification that people are true?
It's an oversimplification. And the way I say it when people ask me questions and when we used to have conferences, those political events that matter to gold. And I have a slide with like 28 things that have occurred over the last 30, 40 years that didn't have an effect on gold or had the opposite effect on gold that people thought. There's a great deal of oversimplification across financial markets, but especially in the gold and silver markets because of their relatively unregulated nature and the belief structure that surrounds gold and silver to a lesser extent. There are a lot of beliefs as opposed to knowledge in there. And it's a gross oversimplification, but, bad things that affect a large number of people tend to be positive for gold. And I joke with my wife and others that, I'm something like an arms dealer. Bad times are good for me. If you look at the best times in my career, 1979 to 1982, 1985 to 1988, 2002 to 2012, bad things tend to cause people to want to own gold. And when you get into a situation, in 2000, we issued a buy recommendation and we said, this is a long-term buy recommendation. If you look at my buy recommendations from 1980 to 2000, they lasted a year or two or three. But in 2000, we're saying that the economic and political environment going forward is going to be more hostile than it was in 79, 80. And that this is going to push gold prices. They were about $270, $280 at the time. This is going to push gold prices far past the $850 peak in 1980. And it's going to go on not for years, but for decades. And we are 20 years into this cyclical or secular upward shift in the investment demand curve. What's happened since 2000 has been crisis after crisis and a devolution of the political structure, the post-war political structure, the post-war currency structure, the post-war financial markets. It's been one problem after another on top of them, many of which haven't gotten resolved, but have gone unresolved and gotten worse, and have been joined and coupled with others. And so you've got an increasingly worse environment. And in that environment, investors no longer buy 20 million ounces, 25 million ounces when things are bad for a year or two, and then they go back to buying 10 million ounces. Investors have been buying 20 million ounces for most years, or 30 or 40 million ounces for most years since 2002. So you've had this upward shift in the investment demand curve with more investors able and actually buying more gold at higher prices for a longer period of time in more parts of the world than ever before in history. And for that to change, that secular upward movement in investment demand for gold, which pushes the price higher, for that to change, the economic and political environment has to change. And, I'm not an optimist, I'm not a pessimist, I'm a realist, so I'll be long gold for the foreseeable future.
Right. So you don't see do you have a target in a sense how long you see this going for? Is it basically kind of event dependent where if things change, then your forecasts change, but as long as things stay the way they are, I'm going to say gold is a great place to be or a smart place to be.
There's a cyclicality built within to that secular upward shift. So, 2000 to 2012, you were in a cyclical upward part of that movement. In January 2012, we issued a report that said a time to sell. And we told our clients, gold, silver, platinum, palladium, if you own them, now's a good time to either sell them or buy puts against them, because we think for the next 3 to 5 years, the prices will be weaker before we enter into a new upward leg on the basis. We think we're halfway through this cyclical upward move. So we've gone from 1,200 to 2,000. We're about 1,900 as we're talking today. Our view is that this goes until 2023, 2025, and the gold price might get to 2,800 on an annual average basis. Sure. It's a much higher intraday basis. In 1980, the price peaked at 850, but the average price was 612.
Yeah.
So, but we have in our main economic scenario that the price then comes down after 2025 on a cyclical basis, while the secular bull market continues. And the secular bull market continues because the big issues like currency regime change and rebalancing of political and economic and financial power in the world, those things are not going to be resolved in 1 year, 3 years, 5 years, 10 years. I mean, if you look at the cyclical, the currency regime, that's something that, we've been talking to central banks since 1980, 81 about, and everybody has talked about it. And the 1980 is going to take decades to unfold. And in 2020, they're saying this is going to take decades to unfold because you can't make a big shift in the international currency regime in a non-violent way quickly. Yeah.
It really does seem like the whole precious metals conversation, in a sense, it seems like it's more about the dollar than anything else. Like, is that the kind of, people talk about gold as a store of value, but in a sense, the dollar seems to me to be the main driver behind precious metals more than anything, and say the gold trade and say even, crypto and whatever. When I see, say, the commodities going higher, you see the dollar go down. How do you kind of frame that relationship within your mind? Like, I see it as a dollar thing, but how do you see it? Rather than copper being so popular, how do you frame that?
The dollar and gold doesn't trade against the dollar. Gold trades against currency markets. So in the mid-90s, you saw the dollar fall out of favor among investors globally, and everybody moving into the market got to be too expensive, and all of a sudden gold rose like $40 because people were saying, okay, I don't like the dollar, but I don't like the Deutschmark, so let me park money in gold. And then Karl Otto Pohl, who was the Bundesbank chairman at the time, came out and said, the Bundesbank does not think that the Deutschmark is overvalued, at which point everybody sold their gold and went back into the Deutschmark. So gold trades against currency markets. If there's a currency of choice, investors will tend to move toward that. But if there isn't a currency of choice, they'll park some money in gold and silver. And that's what's happening right now. And this is true across the spectrum of investors. So you have short-term investors who are looking at the next 5 days, 2 months, long-term investors. And situation where investors are looking at the currency markets, they say the dollar is vulnerable. But if you look at it from an economist perspective, for the dollar to fall sharply, you'd have to have a tremendous faith in the euro. And you'd have to have several other things that just don't exist right now. That's a nice way of saying that I don't have faith in the euro zone economically, being economically competitive. So there are times, but the other thing is gold and the dollar are the two reserve assets or safe haven assets of choice. So you'll find times, like just recently, where the dollar and gold are both rising because investors are getting out of everything else. You'll find other times where they're both falling together because it's a risk-off transaction, if we can use the vernacular of the moment. See, people are saying, take my money out of dollar-based assets and out of gold, and I'm going to put them in stocks and bonds and stuff like that. And then you'll find other times. If you look at it over time, 1968, when the gold price was free to float, to now, it's about a negative 34% correlation. So if you say, oh, gold trades against the dollar and I'm going to trade gold based on where the dollar is moving, you're going to lose 66% of the time. But there is a relationship, but it's not highly correlated on a negative basis, and it's much more complicated. And one of the things that, like in the last couple of weeks, we've been saying repeatedly to our clients and others who would listen, it's not that gold's reacting to the dollar. Gold and the dollar are reacting to the same independent variables that are not in that equation.
So it's complicated than that, in other words, and it's not, there's more than two people in the room, so to speak. It's not just the gold and the dollar. There's a whole bunch going on that relates to that relationship.
My work since the 70s tells me that interest rates, real interest rates, are probably the ultimate determinant of gold prices. But the correlation between changes in gold prices and changes in real interest rates, apples to apples, is zero, right? You know that changes in real interest rates are very important, not only to gold, but every other asset, because that's the benchmark for, is this worth anything? But it's such a complicated relationship, it can't be econometrically modeled effectively.
Okay, and just a last point on that. So how do you measure real interest rates? Do you simply take the official inflation versus the U.S. 10-year Treasury? Like, what is real interest rates for you?
We use different metrics, but mostly what we do is 1-year Treasuries and 1-year Treasuries less U.S. CPI.
Okay, so take the official number, and so you buy, in a sense, the CPI number that they give.
You know, it's funny. I was at one of these gold bug conferences many years ago, and I said, "How many of you, think that the CPI is cooked?" And a whole bunch of them raised their hands. And then I held up a 160-page document, and I said, "Any of you recognize this as what it is?" And they said, "No one." So this is the monthly U.S. government CPI report. It's 160 pages long, and it explains how that number was determined. And no one knew it. I mean, that's one of the great things about gold and financial markets in general is you can have people who are completely ignorant of money and banking, finance 101, gold supply demand fundamentals, but they'll hold themselves out as the absolute authority.
Yeah,
and if you know how the CPI is created, A, you'll know its flaws, and B, you'll know that despite its flaws, it's clearly not being manipulated because it's being run by a bunch of people who see their jobs as being agnostic clerks.
Very interesting. Now, on this whole idea of manipulation, I assume you saw a story on JP Morgan and the big fine they got. I think it was from the SEC or CFTC, whoever it was, for spoofing. So, and as I was telling you before the show, I remember you from way back on the great gold debate on Jim Paplava's Financial Sense News Hour with Bill Murphy and GATA. And the guys at GATA, in a sense, you've always been fighting these sort of conspiratorial views on the gold market, that it's being manipulated, and the silver market. So when you see the JP Morgan story, I thought to myself, well, that's why I actually called you or emailed you. It's like, what does Jeffrey Christian have to say about this? So I'm asking you now, what do you have to say about that? Like, does it ratify the views, or are they wrong?
First off, the settlement was with the SEC and the CFTC, with the U.S. Treasury, being somewhat involved. And it's very important to understand it was the SEC and the CFTC. And the other thing that's very important is that it was about spoofing. And if you look at it, JP Morgan's major thing was that they failed to monitor and provide sufficient oversight to traders, allowing those traders to spoof regularly for a long period of time. And we'll come back to spoofing in a second. I used to have a slide when people would ask me about this. I said, if you go back, big word, all caps, conspiracy. There's this grand conspiracy on the part of governments and central banks and major banks around the world. And when JP Morgan is buying or selling gold, they're doing it on behalf of the Fed. And the purpose is to suppress the gold price or the silver price.
Everybody's in league with each other.
Right. Everything that supports that argument is nonsense and is easily dismantled, as I did not only with the Jim Paplava interview, but I did a live debate with Bill Murphy a couple years later at the Silver Summit that Kitco broadcast, and it's still out there on the YouTube someplace. There's no evidence of such a conspiracy. There's enormous amounts of evidence that such a conspiracy does not exist. So then when that became clear, it was like, well, it's smaller conspiracies. Then it was, well, it's market manipulation. And you start seeing problems and fines, in market manipulation in the fixed income markets, in the currency markets, and then in the precious metals markets. And now it's spoofing. So it gets smaller and smaller. And what you're seeing is that people are regulating these markets better, and they're finding that spoofing goes on. Now, that's nothing new. I mean, if you read Charles Dickens, you know that spoofing has been around as long as established markets in Europe. And they probably existed in Japan and China prior to that, you know. So spoofing occurs across financial markets. And if you look at the JP Morgan settlement, most of what they found was on the fixed income and equity side. And the precious metals was a relatively smaller thing. So what you're finding is spoofing. Then you can argue that if there was this grand conspiracy, your management of JP Morgan were involved in trying to manipulate the price, they would not allow those junior traders to spoof, you know, because you're risking the whole big mashugala for a small trade. And so you can argue that actually that spoofing probably is prima facie evidence that a grand conspiracy doesn't exist. Now, all of that is logical and will hold up in a court of law, but none of it would convince the true believers in gold conspiracies because their beliefs are not based on fact. Their beliefs are based on a religion. And, you know, the guy who Eric Hoffer coined the term true believers, and he said, for a true believer to change his beliefs based on evidence or actual facts is heresy.
Right.
So
right.
you know, if you want to change a true believer's belief in conspiracy theories, you have to be a psychiatrist or a psychologist, not an economist.
Yeah, nobody's dropping their religion based on a rational argument.
Right.
Right.
Exactly.
Okay, so very interesting. So yeah, so I'm glad we covered that. Now, did you also see this report there's a little news story a couple of weeks ago about Goldman Sachs and saying basically the tenor of the article was short the dollar, buy silver. Did you see that? And what are your comments?
I saw that, and I saw the article. We are bullish on silver. We're probably less bullish on silver than Goldman, but then we probably know more about the silver market than Goldman does. And we, for those who don't know, I used to run the commodities research department at Goldman Sachs, and in 1986, Goldman said, "Oh, metals are dead as an investment. Let's get rid of our metals desk or half of it." And I took that opportunity to buy the commodities research department and set up CPM Group because I wanted to be an independent research advisor as opposed to part of a bank. It's funny because we've done a lot of work with the World Bank and the IMF over the years, and there was an economist there who used to introduce me to his colleagues when we were working on various projects, starting to work on various projects, and he'd say, "Yeah, this is Jeff Christian. We're going to be working with him on this project, and understand he quit Goldman Sachs, i.e." Be very careful because he's not an organization man.
Okay.
But,
independent.
We are bullish on silver, probably less bullish on it than they are, and our bullishness is over a 3 to 5 year horizon, not 1 to 2 years. And we're not bearish on the dollar because for the dollar to fall, you have to have greater belief in the political and economic outlook and strength of Europe and other parts of the world. You know, the dollar is reciprocal with other currencies. And if you look, the dollar actually has held up very well. I mean, there was some short-term decline in the last few months, and that decline took it back to the levels that we saw at the beginning of the year or so, if I recall correctly. You know, so
interesting.
The dollar has a long future, and the world can't dump the dollar because there are too many dollars in circulation. Yeah.
How long does this go on for, though? I mean, because it seems like a kind of argument that you could, like, when does that argument fail? All right. How many trillions can they keep printing or quote unquote printing before that argument starts to break down? Like, how far can they push this thing? I don't know if you know the answer to that question, but.
Well, there are several answers, you know, and one is if you look at the U.S. economy and the budget deficits and the trade deficits, it's really sad because these things very easily and painlessly if we had the political will. But we don't have the political will in the United States, so it's not going to get fixed. But you could have a scenario where the U.S. fixes itself and the dollar stays as the de facto reserve currency for the indefinite future. In lieu of that future, that scenario where the U.S. develops a spine and exerts the political will needed to solve these problems, in lieu of that, this could go on for decades, and it has already gone on for decades. I mean, by 2000, 2001, central banks and economists at central banks, the monetary authorities and the IMF and the World Bank and the United Nations, people around the world were talking about what replaces the US dollar in the next international currency regime. And the view then was this will take decades to execute. And 40 years down the road, it's still decades away, and in fact, it's even more decades away because the dollar's hegemonic power in the global currency system has become that much larger. But I'll tell you an anecdote. In 2001, we had a big crisis. NASDAQ fell 86%, the New York Stock Exchange fell 43%. We went into a recession. There were all kinds of problems there, and there was a failure in the international financial regulatory market regime, and there was also failures in the international currency regime. And a lot of that, it led to Sarbanes-Oxley. It led to changes in UK and EU financial market regulations and stuff. And in this environment, in 2002, the Bank of England convened a meeting of central bankers, monetary authorities, economists, advisors, and such, in a really nice estate outside of London. And the head of foreign exchange management at the Bank of England welcomed everybody and said, we are here because we know that the international financial regulatory regime must change and it must be coordinated. Right now, there is no international financial regime. Everybody has different ones. And so the banks go wherever the regulation's the lightest. And we also need to talk about an international currency regime. And he said then, I'd understand governments of the world have never convened a meeting like this in peacetime and agreed on a future financial regulatory regime. Financial regimes have always been built on the ashes of cataclysms. The current one was built in Bretton Woods toward the end of World War II, where the victors said, this is how we're going to go forward as a world. And prior to that, there was an agreement at the end of World War I. And he said, so while this is a very noble effort, we must be cognizant of the probability that we will not come up with a future globally acceptable financial currency regime. That was 2002, 18 years ago. And umpteen crises away, Sure. I mean, the budget deficit in the United States, the U.S. debt was probably something like $10 trillion at the time. Now it's like $30 trillion. So that how it gets resolved is very difficult. And there are people out there who say this can only be resolved by fire, and there's going to be World War III, et cetera, et cetera, et cetera. And then there are a lot of other people who say, well, my granddad told me about World War II, and I want to work really hard to try to find a way to peacefully resolve these issues. And I'm in that group, of people who would like to see international cooperation work these things out. And as I said, a lot of financial and economic issues could be worked out relatively painlessly, at least in the United States. More painful elsewhere, but the likelihood of that happening depends on major reforms in the political process, which I do not see on the horizon.
Interesting. So when the IMF came out like a week ago, 2 weeks ago, I think it was a week ago, on calling for a new Bretton Woods moment, that for you, that's probably not going to result in anything. Would that be fair characterization?
It was October 15th, and they didn't call for a new Bretton Woods moment. If you look at the speech, what they said was, we are facing a new Bretton Woods moment. It meant This is like where we were in 1944, 1945, when we got together in New Hampshire and said, okay, World War II is drawing to a close. How are we going to rebuild the world? And what we need is international organizations. We need the United Nations to try to be there to resolve political problems. We need the World Bank to be there as the World Bank's full name is the International Bank for Reconstruction and Development. It was designed to help redevelop not only Europe, but all of Asia, which was devastated by the war. And the International Monetary Fund and the Bretton Woods currency regime. So all of that stuff was built in the ashes of World War II. And what the World Bank and IMF was, what the IMF person was saying was, that's where we are now. We're at a cataclysmic period of time that's been made worse by the pandemic. And really, this is where international cooperation is most important. And unlike 1944, 1945, we do not have a strong, intelligently run United States government to get everybody together and say, hey, guys, let's work this out. In fact, the U.S. government has been working for decades to postpone that kind of discussion.
Sure. I mean, and it would seem because the current, for lack of a better word, regime works in the favor of the holder of the world's reserve currency. Fair?
Exactly.
Yeah. Okay. Interesting. Now, I don't want to take too much of your time here, but as far as this idea of gold as a store of value, we are seeing in Argentina, Brazil, Turkey, and Lebanon, we're seeing currencies fall. And I'm curious on how you see, say, this cryptocurrency Bitcoin thing, because you see a lot of people gain out of their local currency and they're going into Bitcoin and they like it because it's easy. I mean, even we had this MicroStrategy CEO, I don't know if you heard about him, Michael Saylor, he put in like $150 million company treasury into Bitcoin. And he said it's so much easier than putting it into gold because I don't need to pay $250,000 to have it shipped over and whatever. So I'm just curious in how you see that relationship, how you see Bitcoin, distributed ledgers. What's your take?
So the first thing is the guy who thought it would cost $250,000 to have gold shipped over has no clue how to buy gold effectively. And he's listening to banks and brokers who are saying, oh, here's a stooge who doesn't know anything about gold, and we can take hundreds of thousands of dollars for services that probably should cost tens of thousands of dollars. And CPM Group helps institutional investors, family offices, high net worth individuals build gold and silver positions. And we do it in a very cost-effective way. And we basically avoid almost all banks and broker and dealers. I mean, you know, so we help bring a brutal efficiency to gold and silver transactions. And we have it stored in the proper places, in the proper forms, so that you have liquidity. You can also, in some cases, lease it out and earn interest on it. And you can earn more interest on gold now than you can on U.S. Treasuries. So it's a very interesting thing. So that, but let's talk about cryptos. Cryptos are the anti-gold. Yeah, if gold is no one else's liability, it's a tangible asset that you can store and hold and have, and its value is based fully and completely on people's faith in gold. National currencies are paper assets with unlimited supply, and they are based on the full faith and credit of those countries issuing them. And gold, going back to gold, yeah, it's got a geologically limited supply. There's an enormous amount of gold out there, but it's got a geologically limited supply. Cryptocurrencies are the opposite. They don't exist except as an idea, a chit on the internet. They can disappear immediately. They are based on the full faith in them. There's nobody else standing behind them. There's no government. When you've seen things like cryptocurrency problems like in Japan, people stand around on the Ginza and they say, who do we complain to? And the answer is nobody. It's, you know, you just bought a pet rock. congratulations. And while they say there's limited supply, it's limited because the guy who you don't know, because it's anonymous, says these are the rules I've made that limit the supply. And he can change that with a flip of a switch, the same way national central banks can say, oh, I think I'm going to issue $3 trillion worth of money. So cryptocurrencies are the antithesis of gold. There are probably going to be a whole lot of losses in the cryptocurrency markets going forward. And if an investor really understands what he's buying, he's going to buy gold as a long-term store of value and not cryptocurrencies. Because,
sorry, go ahead.
Gold is a tangible asset that's no one's liability, that has a somewhat limited geologic supply, and it's been around for decades. And you're not going to have somebody say, oh, well, boop, I pulled the switch on that cryptocurrency. Now, I'm a big believer in distributed ledger protocol. It has a lot of work to do before it's foolproof. You have more problems with cryptocurrencies now than you do with the SWIFT system in terms of percentage of transactions that go wrong or disappear or occurrences of graft and scams. But I like distributed ledger protocol as the basis of future financial transactions, but it has a lot of time to come. I do think that national currency will ultimately go into cryptocurrencies simply because that's the logical progression from paper to computer chips to cryptos. But I think there'll be national currencies so that you have them based on the full faith and credit of someone you can identify.
Right. I mean, this is the thing with Bitcoin. I mean, what the Bitcoiners would say is the greatness of Bitcoin is the fact that nobody can control it. In a sense, it's a free currency and nobody can control. I think you're right about all these other tokens and anything like Ethereum and all of these other cryptocurrencies. They can be controlled, a lot of them, most of them, by some kind of central organization. Bitcoiners, though, with Bitcoin, does seem a little bit special in the sense that nobody can control it, and it does have this kind of limited scarcity. And just to put their point, I think they would say, I mean, what they say is, people say, well, what's backing Bitcoin? And they would say, well, what's backing gold? It's sentiment. Now, how do you respond to that?
Well, first off, there's a fallacy there. And it's interesting because it's the same issue that is the difference between human intelligence and artificial intelligence. You have an axiom. And in the case of Bitcoins, the axiom is inaccurate. There is someone there. There is a man behind the curtain. And it looks like nobody can control it, but the man behind the curtain can flip a switch and change it or take it all away in a moment's notice. He knows who he is. Well, he does. Right? So that's a big problem, even with Bitcoin. There is ultimately somebody there. And because it's an axiom that he's not there, people involved in Bitcoins assume he's not there. But that's a false axiom. Gold is based, as I said, the value is based on the full faith in gold. Why was gold worth $250, $260 in 1999, 2000, but $2,000 this year? Because in 1999, 2000, a lot of people foolishly believed in what was called the new economic paradigm. We had had 20 years of relatively strong growth, low inflation, low interest rates for the last 10 years of that, strong growth in productivity, computerization, deregulation, globalization. You had a lot of really powerful economic conditions pushing strong growth for 20 years. And in that environment, a lot of people said, why do I need gold? Or they said, I was stupid enough to buy gold at $600, $700, $800 in 1980, and I held on to it because I thought the price would get back there, and I'm giving up the ghost. Or my father was stupid enough to buy gold at $600, and I have to settle up his estate, so let me sell the gold and keep the IBM shares because IBM will last forever, but gold, what's gold? So in 1999, 2000, gold was worth $250 because there was great faith in the global economy and the U.S. government. And At that time, the U.S. government was running budget surpluses, and over 4 years paid down about $1 trillion of its debt. And the dollar was rising.
Yeah, right. Right.
We had a new economic paradigm. We had strong growth. There were people who actually believed the stock market would go from $10,000 to $40,000 in a matter of months.
Mm-hmm.
So why own gold? So gold was worth $250. Gold prices are not stable over time. The idea of a gold constant, real or nominal, is nonsense. It's not based on facts. If you look at real gold prices since they were allowed to float 1968, they've gone on an index basis between 100 and 800. So you have this tremendous volatility in gold prices. It's not that you buy gold and its purchasing power stays the same. It's that you buy gold, you add it to your portfolio, and you diversify both the denominator and the numerator of your wealth, as well as your portfolio, which is a subset of your wealth. And you have a diversified portfolio that, as I said, has zero correlation. Part of it has zero correlation to interest rates. Part of it has negative 34% correlation with the dollar, and about a 17% or negative 17% correlation, I think, with stocks. So it helps smooth out the volatility of your wealth. Mm-hmm. Shit hits the fan and you have to flee your country. Your gold may fall in value, but not as much as other places. If you go to Thailand in 1997 when the Asian currency crisis hit, a lot of people who had traditionally owned gold had sold their gold and they were investing in the Thai stock market and other paper assets, and they lost 80%, 90% of their wealth. Some people had kept their gold, and they found that they were able to buy the companies that the other people had built out of bankruptcy. So there's a great reshuffling of wealth within Thailand and across Southeast Asia. And the people who had the assets to buy the other people's bankrupt assets were the people who had some of their wealth in gold.
Right. So, and finally on that point, and then I'll just ask for your outlook as we wrap up. But so would you say that's gold's main benefit as a diversifier in your portfolio?
Yes.
That is its main sort of role and value?
Yes. I mean, the reality is you can go anywhere in the world with a piece of gold and start a new life.
Sure. Yeah, fair enough. Fair enough. And so do you have any outlooks for us? Before we go right to that, I've been looking at platinum, and to me it seems like the ignored metal. I mean, palladium went parabolic in the last 12 months. We saw gold has gotten a ton of attention. Silver has gotten a ton of attention. I see platinum as this kind of ignored precious metal. What are your thoughts on platinum?
I have many thoughts on platinum, but if I can summarize them, it has been ignored and deprecated. There are people starting to look at it. Our expectation is that the platinum price will rise, but it's probably 3 to 5 years away before it starts rising. And it's primarily our expectation that the price will rise based on the fundamentals of the platinum market. Because platinum is not a financial asset. It's a much smaller market. It's a much more specialized market. It's a much more opaque market. There's a tremendous amount of misinformation that circulates in it. So you have any number of investors who look at the platinum market and then throw up their hands and say, I'm not going to touch this because there's too much nonsense. There's too much noise. The sound to noise ratio is far too low in platinum for me to get off my liquidity.
Okay, interesting. Do you think it will outperform the other metals or not?
I think it'll outperform palladium in the long run. Maybe not in the next year or two, but in the long run, I do think that platinum will perform very well relative to palladium. I'm not sure that it will outperform gold or silver because those are financial assets and there are a lot more people interested in owning them. And governments around the world are working really hard to convince people, give them reasons to buy gold and silver.
Right. And so finally on that point, as we wrap up, do you have any price targets for us in the, say, near, midterm, or a year out?
A year out, we think gold will be modestly higher, maybe 10% higher than it is now. We're looking for some plateauing. Gold prices have risen sharply over the last year. We're looking for prices to continue to rise, but to slow down in 2021, 2022, and then the rise accelerates, and if you're a technical analyst, you would think it'd be a second leg of a measured move. So if you have the price going from 1,200 to 2,000, and then it sort of settles around 2,000, 2,100, 2,200 for a couple of years, and then it goes from 2,100 to 2,800 by 2024, 2025, depending on when the next recession hits, and there will be one. So that's our view on gold.
And silver?
We're looking for the price to rise to record levels in the same sort of pattern. Obviously, it'll be more volatile than gold. And again, on an annual average basis, I think we're talking about maybe $45 as a peak silver price, compared to $35 on an annual average basis in 2011, 2012, when the price touched $50 on an intraday basis.
Interesting, right? Yeah, I always have to pay attention to those annual averages because I'm always thinking, why are these prices so low? BMO had their $1,400 announced for gold,
yeah.
But yeah, these are annual prices. Anyway, Jeffrey Christian, any parting thoughts?
I think that the length and breadth of our discussion is, the main takeaway. Gold, as I said, gold is a very complicated market, and it's one of the reasons why I've found myself fascinated by it. I was a kid who liked to take apart transistor radios and other things and see how they worked when I was a really little kid. The gold market is sort of like a new piece of electronics that came from outer space or the U.S. Defense Department, and you take it apart and you say, wow, what is this? And it's such a complicated market. So you have to look at, one of my critics in 1988, 89 said, Jeff Christian's not good at calling the gold market. He's just good at predicting global economic and financial markets.
As if that's
so I'll take that criticism.
Pretty lame, yeah.
and it's true. The people who got gold wrong in 1988 were looking at gold supply demand, and they were just drawing straight lines and saying, the price has gone from $290 in 1985 to $500 at the end of 1987. So it's going to be, $1,000 in 2 years. And we were saying, no, the world is not in a recession. Recession's probably 2-3 years out. Interest rates will remain relatively high. So we're talking about prices coming back down. And that's the cool thing about gold. And you got to know about interest rates. You got to know about money and banking, international currency regimes, currency rates, financial markets. You get the stock market, the bond market, and the currency market right, you can understand where gold's going to go. You get those things wrong because you've got bad information or bad analysis, you're going to get gold wrong.
Interesting. So it's right. Would you say it's the heart of the financial system?
I wouldn't say it's the heart of the financial system. It's sort of like the little toe.
Okay, yeah, fair enough. Great. Well, thank you, Jeffrey Christian, for joining us on the podcast. What an amazing conversation. I can't wait to share it with everybody. And please come on the show again.
I've had a lot of fun. It's been good to have a good substantive conversation. Sometimes, in the gold market, you find yourself crying when you have a good conversation, because conversations that dwell in all of this muck and distractions are so common in the gold market. So it's been my pleasure, and anytime you guys want me back, I'm around.
All right, great to hear. Thank you once again, and enjoy your day.
Yeah, you too. Bye.
All right, thanks, Jeff. I'm going to hit stop recording here.